Michelle, so you're the economist. You looked at these numbers, you saw the report. Are you as confused as the rest of us right now about what's going on here? And by the way, does this data significantly take the odds of a recession lower?
It certainly has pushed back the timing of a recession. We still have a recession in our forecast, but whereas we thought it would be predominantly a first half of 2023 story, it now clearly looks like it's going to be delayed, and we've pushed our expectations for negative GDP growth to the second half of the year. I mean, stepping back, I don't know if I think, I don't know, Steve, I don't know if I think the economy is reaccelerating, but it clearly isn't decelerating in a straight line and as sharply as it appeared to be in the fourth quarter. We really seem to be losing momentum throughout the fourth quarter, culminating, as you said, with those December numbers that were kind of through and through very disappointing. I think that this, suggests that it's not going to necessarily be a straight line, and it's not going to be perhaps as weak as soon as we thought. It's going to continue to be sort of a gradual deceleration. And I think for the Fed or for markets, there's still a confidence that the Fed has done an awful lot. They don't necessarily have to do a whole lot more. People aren't going to be revising up their terminal Fed funds forecast. So if you've got inflation coming down, you think most of the Fed action is done, and you're still seeing the economy holding up. I think that's how you get to a situation where the markets really like this news.
Okay, so Peter, you and I have been looking at each other, and you seem like you've got a little bit of certainty in your eyes about whether you think this is a clearer read or not. Has this clarified anything for you about the U.S. economy, or have things just gotten murkier?
Well, the jobs number itself is clear as mud, but everything else that I look at seems to be pretty clear. What's so interesting about the number is it is such an outlier to such a great extent that I don't know whether to rely on it. The household survey within the overall number, that can be explained. There was a population adjustment. If you take out that adjustment, there was only 84,000 jobs added in the month, but I can't explain the establishment survey. But I look at the ISM services number today. The employment component was exactly 50, implying really no real net hiring. You have the S&P Global Services PMI that said there's been a notable halt to hiring. We see the continuing claims data being elevated. I listened to a lot of company conference calls and a lot of just general cautiousness and a limit to hiring. So the number came out of left field, and I can't have that yet alter my opinion on what is clearly a slowing economy and one that I think is in a recession.
Already in a recession.
Manufacturing's in a recession, housing's in a recession, consumer spending in November, December on a real basis was negative. We're essentially there.
So how then, Bob, and I'll turn to you for this one, where's the disconnect between the markets and that narrative that Peter is explaining right now, because he seems to have data to back it up?
Right. I agree the jobs report is confusing, but when I'm confused, I just look at the market and try to say, what is the market telling us? So I see startlingly strong jobs report. I see rates up today, and I see the stock market holding in there really well, considering the news, and particularly disappointing tech earnings on top of that. So this seems to be implying that the market may be comfortable with the idea that it's kind of wrong on the rates. They're expecting the Fed to cut rates a little bit towards the end of the year. They may be wrong on that. But if the economy is so strong at this point, it may be able to withstand higher for longer, even at 5% by December. And we could indeed get the soft landing. That seems to be the way the market is reading this data right now.
Michelle, I'm watching you nod, possibly in agreement here. So take us through your thinking.
Yeah, I think that's really it. I think that as I said, I don't think anyone looked at these numbers that were, again, unequivocally strong and starting to say, wow, the Fed is going to have to take rates a whole lot higher than we thought. It is, as you probably said, Bob, it's more of, okay, at the least, at the worst, we may not get the rate cuts in the second half of the year that we've got priced in. But as you said, if the economy is holding up better, then that might be okay. We might get into this point where, you achieve this soft landing. And as I said, when you step back, as long as inflation keeps coming down, and that, of course, is the wild card. Can you have these kinds of strong employment numbers, continued strong labor market, and see inflation make it all the way to 2%? But as long as it's moving in the right direction, signs that the economy is holding up don't necessarily have to mean it's bad news for the equity market.